Hello and welcome to Options Guide TV. My name is Brian Overby. I'll be your host here for about the next 30 minutes on Options Guide TV. I am traveling. I'm actually at the Options Industry Council in Asheville, North Carolina. So we'll be doing this remotely today, but already had a lot of news that has hit the marketplace. We still have a bunch of earnings. We have the Fed going to meet today, and it's highly likely that they will do nothing. They will not adjust the Fed funds rate today, but everybody's going to be listening to Jay Powell and his comments in the press section after the announcement. And right now, there's still most of the major banks and most of the people that are following the Fed have at least one rate cut planned for the year. But a few people, after a lot of the economic data that we've received today on JOLTS and also last week, uh, have said, well, there could be a potential for a rate increase. Oh no. All right. And the market did react because of that potential. Market got beat up last week and it's continued to get beat up a little bit more this week. We were bullish in the S&P 500 index. Last week we had a skip strike butterfly on and we had to adjust it. We had to work with that trade quite a bit. I actually more adjustments than I think we've ever made on a skip strike butterfly since we've started doing a weekly SPX trade here on Options Guide TV. So we looked at just a long call spread. We also looked at a trade on Amazon on Monday's show. And then this week we have, I figured we'd do something in Apple. Apple is kind of making some headway a little bit. Everybody's talked about how poorly they have done out of the Magnificent Seven relative to the other companies that are in the Magnificent Seven. So we will look at actually a protection strategy in Apple. I'm not going to take a direction. I always have had a feeling that whenever Apple announces earnings, a lot of times, if they've had a decent run up, people will take that opportunity to sell some of the Apple stock. So I'm going to come up with a protection strategy because that's what Options Guide TV is all about. It's about taking the 40 different plays that are inside the options playbook and applying them to certain conditions. So we talk a lot about strategies around earnings because you learn so much about strategies when you're talking about earnings, because the dynamics and the option pricing is just explosive, especially if you're looking on shorter term options. So we're going to look at what's going on in Amazon. It's an interesting trade because Amazon's really, they've announced earnings and they're going nowhere. They're going up. They had a good earnings report. But once again, they came out much like Meta and said, well, we're going to have to spend some money on AI. So even though the earnings report was solid, and it was also solid in Meta, a lot of people are hesitant on the underlying stock and what that big spend means, and makes a few people nervous. So right now we're seeing Amazon up about 2.2%, up $4 on the day. It's still below our strike in our very speculative trade that we put on Monday. So before I get too far ahead of myself, let's go to the SPX and let's look to see if it's plausible to hedge the trade that we want to put on today. So right now I have the SPX. It's down 8. There you go. It ticked down to actually hit down 8 on the day. We have the VIX index staying around 16% right now. So that's came off a little bit on the economic news from last week, even though we've had some down markets, and the Fed still hasn't met today. So the fact that we've came off a little bit from last week is interesting because the markets have been struggling. Markets have been volatile within the channel. That's the way that I would put where we're at in the marketplace. And the VIX being at that level, and I expect it to kind of stay within this range. I don't see I see a lot of volatility in the marketplace. We're at first day in May, and you've probably heard this already today from some pundit, but sell in May and go away, right? So not a good market right now coming into May. That old analogy is so far proven to be true on May 1st. But with that mentioned, I just think there's going to be a lot of volatility, a lot of nervousness until we really can start taming the inflation data once again. And the government keeps spending money. We keep sending aid packages. I'm not making a judgment on if we should or we shouldn't, but that also hurts inflation because more and more money is coming back into the economy. But the jobs numbers were down today, the jolts, and that is the one thing that has really propped up the marketplace and really kept the inflation rearing its head. We've had very low unemployment. We also, when you look at a strong consumer, and we had mixed metaphors as far as the consumer is concerned this earnings season. uh, MasterCard coming out and saying they're seeing a strong consumer, and then turn around and have Amazon saying that, well, the consumer is changing their buying patterns, is the way that the CEO of Amazon approached it. So we are seeing a little bit, I'm going to say a little bit of weakness in the consumer for the first time, and that has created a headwind for the market. And we see the VIX sticking around, being sticky around the 16% level. I expect that to stay for the next month or so, right? And trading within that range. The VIX is very unpredictable, but I do expect it to be a little bit higher as opposed to lower. I don't expect it to go down back to the 12% level, or the lower levels that we saw over the last 6 months. Okay, so here we go. In the S&P 500 index, we did a very, very small, not very wide, long call spread. And we were all the way up. We're still within a one standard deviation move. So I'm going to highlight here on my chain that we're looking at the May 3rd expiration. And I apologize, I'm just working with one screen today, but we'll get it accomplished. And we bought the 5105 and we sold the 5110. So right now we're looking at about a 19 delta. So the probability has changed quite a bit. It was a 50-50 bet. We straddled the market. We bought just about as much time premium as we sold, that kind of scenario. And actually we bought less time premium than we sold, because we actually sold the most at the money option contract at that time. So here's where it's at. So we're going to buy this one, we sell this one. So right now we see that this is trading for 95 cents. When we put the trade on, it was trading for $2.40, and now it is 95 cents. So obviously you can say, all right, the market wins. They went a different direction than I said that they should. And so I'm down on that position. I'm down over half on the trade. So this isn't a bad out point if I was just trying to manage my risk by putting a trade on and then just getting out of the trade. But I said that we might adjust this trade. Now, we looked at a 10-point wide spread, and that's a little bit more common what I would do in my own trading. But I didn't want to bring in, we go wider on the spread, you end up paying more for the initial trade, which means you have more upfront risk. So as opposed to just selling this out, here's the adjustment that I like to do. And I usually would do it, well, the market was down hard on Tuesday. Might have did the trade on Tuesday. It's Options Guide TV. It's still relevant right now. So what we can do, as opposed to selling this and just bringing in 95 cents, we can leave ourselves with a chip in a chair. We're going to basically, that's a poker analogy, that if you still have money in the game, you can still get your money back. You still have a chance. As soon as your chips are gone, as soon as you close out that position and no longer have any more options, um, then you're done, right? Then your trade is over. You've took your comeuppance. You have uh, put that loss down, and the week goes on, and then you go on to another trade. Not a bad scenario to do it, but here's what our alternative will be here. We're 5 points wide on this spread. A butterfly means that you are long one call spread, or a call debit spread, or a bull call spread. Those are different names for them. You are long one call spread, and you are short one call spread. Well, if we were in the butterfly, we would have set that up to begin with, but we're not. So now we're going to leg into it. So we need to sell one more of the 5110s and buy one of the 5115s. Now, unfortunately, that's a very tight butterfly, but it still gives you an opportunity for the market to try to come back that way. And maybe, you can say to yourself, I don't want the cheese anymore. Just let me out of the trap. That scenario. Okay. So here we're going to get rid of this one, the 5105. I'm just going to remove it because we already own it. We would already be long that trade. We're going to add one more of these, and then we're going to buy one of these. So I got to get rid of one of them. We're going to add one, but ideally in this scenario, if we do this, we're getting a net credit of 85 cents. So let's think about this. We'll call it $1. We'll say that we could have sold the trade out for $1 and got out of that trade. If we sold that trade and we were out of the entire position, we would have fixated a loss for the week of $1.40, and we would have been out of the trade, no more position. If we just do this, alternative, and we sell this option contract, we will then bring in 85 cents approximately, and we'll call it 15 cents less than if we just sold out the position. But then if the market starts coming back, we still got a position on. We still got a butterfly on, albeit a very tight butterfly. So it's going to have to we're going to have to get some time decay for it to pay out and actually help out on our trade. But it is 5 points wide, and it is possible that if it came back in our direction, that we could maybe sell it for $1 and help our entire position out. It still gives us a chance, if you will. So you can adjust it in a different way too. If you want to go a little bit further out, instead of buying the 5115s, you could buy the 5120s. Now you have a skip strike butterfly that we've done before, but you bring in another 80 cents. I'm just looking at the difference from the ask from $7 to 620. So you would bring in $1.60 on the trade. You'd have a little bit higher, but you're adding $5 more of risk. So you got to ask yourself if you feel okay with that, because we're still within a 1 standard deviation move, right? Here's where the market is at, and the Trade Hawk options grid graciously lets you know that where the shading starts is about a 1 standard deviation move. So it's still feasible for the market to get to that range. We're trading right at about a 16% delta, which means there's a 16% chance of it finishing 1 cent in the money by Friday. Okay, now I like this scenario. I like the way the dynamics of the option pricing in this scenario, right? You put on a long call spread. The market goes up. It's simple. It's 5 points wide. You get a 30-point move. You can get close to the maximum on that trade on the upside. It doesn't necessarily matter that we did it on Wednesday, but long call spreads will max out either if they get deep in the money or as expiration approaches, mainly because you bought a call that wants the market to go up, and you sold a call that wants the market to go down. So they kind of fight with each other. Obviously, the dominant option contract is the deeper in the money option contract, the option contract that you bought. Now, when you do this scenario on a butterfly, the only way a butterfly ever pays out, if if you are correct and it's landing within the wings of your butterfly, is close to expiration, or if implied volatility really drops off. So if you had vol come off, if you had it's a lot of time decay, which happens in the S&P 500 index. If you go from Wednesday to Thursday, you get a lot of time decay, and from Thursday to Friday, you get a massive amount of time decay. You see these option contracts are still trading for right around $7.
Hi,
So,
Brian.
yes.
Yes. Could you reshare Trade Hawk? The screen is frozen for
Oh, it
Trade Hawk.
is.
Yes.
Okay. Thank you.
Yes. Let me see if we can.
All right. Pull it out just for 1 second here. Because my screen's running just fine.
Yeah.
Are we back in the saddle?
Up and running again.
Okay, excellent. Okay, so I don't need to get a little bit more long-winded. If it's frozen, I don't know exactly where it was at, but here's the adjustment. And we'll leave it at that. And then we're going to go and look at our Amazon trade and talk a little bit about Apple. So if I sell the 51.10, I buy the 51.15, that would make my position a butterfly. And our position would ultimately, and we'll go back and just reset everything. So here's the way that it would look. We would buy this, sell 2 of these, and buy 1 of those. And that would be our finishing position. We'd only have a 10-point range that the market could land in. And like I said, you could skip this strike and go to this one, bring in a little bit bigger credit. But you do have a chance that the market could come back, and maybe you can sell the butterfly for $1 and save a little bit more. So you're risking about 15 cents for a chance to hopefully add another dollar to your position, and make your loss a little bit more minimal. Now, if we started with the 10-point wide one, well, then you'd have a 20-point range. So that's one of the benefits of starting with a little bit wider S&P 500 index spread. And we looked at that one on Monday's show if you want to go back and review it. All right, let's look at Amazon. So Amazon, like I said, has been wishy-washy. Yeah, it actually was up a little bit higher today. I kind of surprised the way that it is acting. We got implied volatilities have came off. They announced earnings. It's up $2.50, only 1.4%, which is just a normal day in Amazon, not usually after an earnings date. We did the short-term options once again. We're looking at the May 3rd expiration. So we have the May 3rd over here. And we did a ratio spread inside with the call option. So looking for more volatility. We haven't gotten any volatility hardly at all, but we sold the 8250s and we bought 2 of the 9250s, looking for more than one standard deviation move. But the good news would be is if the market went down, we did it for a net credit, and that net credit was around $1, and we would make that net credit. So now that Amazon has decided to be wishy-washy, it makes the trade interesting, to say the least. All right, so when we sold the 182.50, this was trading for like around $4 because implied volatility was so high, and so that has came off. So here's where we're at right now. We'll set up the initial trade, not if we were to sell it, but if we were to sell it today, not as if we were going to unwind it. So the 182.50 option contract is trading for $1. We bought 2 of the 192.50s, so we go 1, 2 there. And right now that's a net credit of $1. All right. So it's very close to what we put the trade on for. And we could go out and unwind this trade right now and pay 90 cents and be break even on the trade. And I don't think that I would want to do an adjustment. So based on we do see implied volatility. If we don't think it's going to get to 180 today, if we feel fairly confident that it would stay below that range, I might wait one day to see where the market is at. But bottom line is we're up about a dime. We put the trade on the market. Nothing really happened. We had a $1,000 margin requirement on the trade. Amazon went nowhere. And now we could get out of the trade and make a dime on the trade. And I think that would be the most simple thing to do. So how would you do that? Excuse me. We would go, and this would be a buy to close, and this would be a sell to close, and you would unwind it and pay a net debit of a dime for that trade. All right, that was fun. It was fun setting it up. Haven't done a ratio spread in a real long time around earnings, but we were looking for a little bit more volatility than less. Okay, so now lastly, a lot to cover here. Apple. Okay, so now on Apple, a lot of times going into their earnings, I just always like to mention uh, if you're nervous about the stock and the last few earnings, well, just in general, Apple hasn't performed as well as a lot of the Mag 7s. It's been doing better recently. It has a tendency sometimes to sell off after an earnings announcement, but once again, we have the AI scenario out there, and they're going to be getting a lot of questions about AI, and who knows exactly uh, where their issues might be, or what their spend might be, or what might be said about AI. But they're going to get a lot of questions about that and where they're going. And then obviously we have China, and China is a big deal for Apple. And then they also have some pending insurance issues, or I'm sorry, pending lawsuit issues over in Europe and just I don't know across the board. A lot of stuff has happened in Apple recently. A lot of news. So almost everybody has some way, shape, or form some Apple in their retirement account or maybe in their regular account. If they don't have it in actual shares, they might own something S&P 500 index fund or just some type of fund. The odds are very high that Apple is in that fund. So if I'm looking to buy some protection, let's talk about this. I never like to just buy protection outright. I don't ever like to just buy this put, especially around earnings, because you have an increase in implied volatility. It's this put option, the stock at 170.86, the closest out of the money option contract is the 167.50, and it's trading at a 64% implied volatility. I'm going to give it a little more time. I'm going to go out to the May 10th expiration, which is 9 days away. And I am going to go down. I'm going to buy the 167.50. That's trading for $2.70. Well, that's even more expensive, right? Because we have 9 days to the expiration date. Well, now I'm going to sell something against that position. So we'll buy this one and we will sell this one. And that is a long put spread, but it will be 100% 100% done as a protection on our 100 shares of stock. So if I have 100 shares of Apple in my account and I buy this long put spread, I reduce the cost of the protection overall. I get 9 days worth of protection. I really want Apple to go up because I have that 100 shares. So I'm bullish but nervous. I'm not bearish on the underlying stock. And for every 100 shares, I would put on one of these put spreads. And so we'll go through the math. Let's buy this one and sell that one. And now you're talking about $1.87. And the risk would be from, we'll call it 171. Our help doesn't kick in until we get to 167.50. So you kind of think of that as a deductible, just like if you were buying car insurance. So if we do this trade, you're looking at risk from 171 down to 167.50. So $3.50 plus the net debit paid, and we'll call it 185. We'll make that simple too. So plus $1.85. That is $5.35 is our maximum risk, but our risk doesn't go all the way down to zero, right? Our help, I should say, our insurance only goes down to 160. We are buying insurance at 167.50 and then selling the rest of the insurance from 160 all the way on down. So you're looking about 3% of total risk over the next 9 days on your 100 shares. That's adding the premium that you're paying for your insurance policy and the deductible together. And that comes up with about $5.35. Divide that into Apple stock price, and you're talking about a 3% total risk on your 100 shares of Apple. And I want to emphasize, you're saying that you have 100 shares of Apple. That's why we're doing this. I'm not doing this to try to get bearish on Apple. I'm trying to protect a portfolio that has Apple stock in it, which I do have in my own account, in my own retirement account. I do own I do own shares of Apple. So the good news here is that if earnings come out and the market does, let's say it does what Amazon did, right? Absolutely nothing, just kind of hang around where the stock is at. You can still sell this and you can still get some of this back. If the news comes out and the market does not drop like Meta did, and it does not fall off a cliff, well, you can still sell it and salvage something. Or if the market does fall off a cliff, you can sell the long put spread and still remain long Apple. You don't have to use the long put spread to actually sell your Apple. And I don't think we have any questions, but if you have any questions on it, please do put them in the chat box. Please do put them in the chat box. And if not, well, I see it's time. And we completed another edition of Options Guide TV. I will be back in my office on Friday. So we'll look at what happened with Apple. We'll see how our adjustment on our S&P 500 index trade played out. And we're out of Amazon. We made our play. It didn't happen. We made a dime. We're out. So that's it for this edition of Options Guide TV. If you're on the Tradier YouTube platform, please click subscribe, ring the bell. If you are following this on x.com, please follow me. I would appreciate it. And we'll see you this Friday for the next edition of Options Guide TV at 11 a.m. Eastern Time. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actually actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.